Okay, so, we're all just swimming in this constant stream of information, right? Trying to figure out what actually matters, what's worth focusing on. Well, that's basically our job today. We're doing a custom deep dive, looking at some really interesting documents about a company that uh, quite literally keeps the world moving. GE Aerospace, we've gone through, recent financial news, their latest press release, even the full transcript from their investor update call. The goal here is simple. Cut through the noise, pull out the key insights from their latest earnings and what they're saying about the future.
Yeah, it's actually quite fascinating when you lay it all out. You can really see GE Aerospace's strategy solidifying. This deep dive, it should give you a real shortcut to understanding not just their recent performance, which was impressive, but also what it means for their strategy and, the whole aerospace sector. It's a story of, well, transformation and focus.
And what a story it is, especially when you look at these second quarter results. Outstanding is probably the right word. Let's just say the numbers for Q2 2025 didn't just meet expectations, they flew right past them. Adjusted EPS, for instance, $1.66. That's way above the $1.43 expected. Big beat.
It really was. And it wasn't just EPS, was it? Adjusted revenue, over $10.1 billion. That also crushed forecasts. We're talking 23% year-over-year sales growth there. And even if you look at the GAAP figures, the story's pretty consistent. EPS up over 20%, revenue climbing more than a fifth compared to last year. What's really striking, I think, is these aren't small incremental gains. We're seeing pretty substantial growth across almost every key metric. It just signals really strong execution.
Yeah, definitely powerful numbers. And the profit growth backs that up, 63% gap or 23% adjusted year over year.
Yes.
But for me, the one that really stood out was the free cash flow. Nearly doubled. Rocketed at $2.1 billion.
Yeah.
That's a huge 92% jump from last year. Just massive. And orders look strong too, up 27%.
That's right, 27%. And that near doubling of free cash flow, it speaks volumes, doesn't it? About their efficiency, how they're turning revenue into actual cash. Like CEO Larry Culp said, it was an excellent second quarter. Free cash flow nearly doubling, more than 20% growth, pretty much everywhere: orders, revenue, profit, EPS. And if you glance at the balance sheet, they finished with, what, $11.8 billion in cash? For a big industrial company, especially considering where GE's balance sheet has been in the past, that's an incredibly strong position. Shows a real turnaround.
Okay, so the numbers are clearly outstanding. But the real aha moment, in any deep dive is understanding the why, how. How did they pull this off? We heard about their flight deck lean operating model. The CEO talked about prioritizing safety, quality, delivery, and cost was in that order. How does that actually translate?
Well, if we connect the dots, a really significant driver, and it's becoming more important, is the surge in demand for aircraft maintenance. For services, you see airlines are dealing with these ongoing supply chain headaches for new planes, plus manufacturing costs are up. So buying new jets, less attractive right now. Instead, they're basically choosing to keep their existing planes flying longer, extending the operational life. And that creates what GE calls unprecedented demand for maintenance, repair, overhaul, MRO. It's not just a temporary thing. It feels like a fundamental shift in how airlines are managing their fleets.
And that aftermarket services business. That's always been a high-margin area for companies like GE Aero, hasn't it?
Oh, absolutely. Strategically, it's a real sweet spot. Why? Because those aftermarket services, they typically bring in significantly higher profit margins than selling new engines. You've got proprietary tech, certified parts are a must, long-term contracts. It keeps competitors out. And beyond that structural advantage, their flight deck thing, it's clearly working. They're seeing real improvements, like material input at key supplier sites, up 10% sequentially. Suppliers delivering over 95% of what they promised. That's almost double compared to early last year. They cut the lead time for CFM56 fan modules by over 30% in Brazil, turnaround under 80 days now. And they're even using AI for blade inspections, more accurate, more consistent, and cuts inspection time roughly in half. So these aren't just small tweaks. They're real gains, helping them meet demand and boost profits.
Right. That intense focus on efficiency, getting the most out of existing assets, it clearly fuels their confidence about the future. Which brings us neatly to the guidance. They've raised it significantly for 2025, and they have this ambitious 2028 outlook too. So for 2025, adjusted revenue growth goes from low double digits up to mid-teens, operating profit bumped up to, from $8.2 billion to $8.5 billion now, and adjusted EPS lifted from the $5.10, $5.45 range to a higher $5.06, $5.80s. Even free cash flow gets a nudge up, targeting up to $6.9 billion. Quite the upgrade across the board.
It really is. So the obvious question is, what's underpinning all this confidence for the next few years? And then you look at the 2028 outlook, which is even more revealing. Revenue expected to grow at a double-digit CAGR through 2028. That's up from high single digits before. Operating profit projected around $11.5 billion. That's a big jump from the rough $10 billion they talked about previously. Adjusted EPS aiming for around $8.40, and free cash flow at least $8.5 billion.
Those are seriously ambitious targets. What gives them that kind of long-term certainty? Especially when, the wider aerospace market still has so many moving parts.
It loops right back to that strong operating performance and, crucially, the outlook for commercial services. A key thing to remember, a full 70% of GE Aerospace's total revenue comes from services. That's recurring, predictable, and highly profitable. It provides a really stable base. Plus, they've locked in some huge long-term deals fueling that massive backlog. Think Qatar Airways, over 400 GEnx and GE9X engines, IAG buying GX-powered 787s for British Airways. And on the defense side, that big $5 billion U.S. Air Force contract for F-110 engines. These aren't just quick sales, they mean sustained revenue for years to come.
So it's not just about today's great results, but they've built a very clear, strategically secured runway for growth. And they're investing heavily to support it, right?
Yes, absolutely. Big time. Nearly $1 billion planned for investment in U.S. factories and their supply chain just in 2025. That's almost double last year's figure. $500 million of that is to expand capacity for the CFM LEAP engines. Over $100 million for innovative materials, think additive manufacturing, ceramic matrix, composites. Another $100 million plus going to external suppliers. And they plan to hire about 5,000 people in the U.S. this year, too, in manufacturing and engineering. It's a serious commitment to build the capacity they need to hit those growth targets.
Okay, let's shift a bit to the technology. How are they using tech and operations to stay ahead? They seem really focused on durability, reliability for existing engines. Like the GX durability package resulted in more than 2.5 times increase in time on wing. That's roughly 5 years between shop visits. For airlines, that's huge. Lower costs, more planes available.
It's absolutely a game changer for operators, and they're taking those lessons across the portfolio. The EAP-1A durability kit came out late last year, aiming to match the CFM56's legendary performance. The EAP-1B kit, expected first half of 2026. This constant push to extend time on wing for current engines. It's critical right now, given everything we said about airlines keeping planes longer, fits perfectly with that high-margin aftermarket strategy.
And what about the brand new engines? Where's the innovation frontier there?
Well, take the GE9X. They call it the most tested engine in GE Aerospace history. Over 30,000 cycles, like 6 years of flying, plus 1,600 dust tests. They want it super mature and reliable from day one. And looking further out, the long-term innovation piece. You have to talk about CFM Rise. It's a technology demonstrator program aiming for at least 20% better fuel burn. It uses this radical open fan architecture. Picture a huge fan, not enclosed like usual. It spins slower, so it's quieter, inherently safer, but still gets massive efficiency gains. Instead of pushing the engine core super hot, it gets more work from the fan. Better durability, greener too.
And it's not just commercial engines seeing this push, is it? Military side, too.
Oh, yeah, absolutely. They're making big strides in military propulsion. The XA100 adaptive cycle engine promises 25% better fuel efficiency, 30% more range. Plus, they're involved in the Global Combat Air Program, GCAP.
So what's the big takeaway from all this tech talk? It really signals this fundamental shift across aviation. It's about maximizing value from existing planes, better maintenance, upgrades alongside developing these innovative, durable, new designs. And that whole picture, it plays right into GE Aerospace's strengths, right? Okay, let's touch on capital allocation. How are they planning to use their resources, their cash? They've laid out 3 clear principles. Invest in the business for growth, return cash to shareholders, and then maybe some opportunistic bolt-on M&A.
And this disciplined approach, it really signals their confidence in keeping profits and growth going, doesn't it? They've committed to returning over 100% of free cash flow to shareholders through 2026. I mean, that's a huge pledge. They're actually boosting planned returns for 2024-2026 by 20%. That brings the total to about $24 billion, roughly $19 billion in buybacks, $5 billion in dividends, and after 2026, they expect to sustainably return at least 70% of free cash flow each year. It shows deep, long-term confidence in their cash-generating ability.
Yeah, here's where it gets really interesting. The strategic clarity just shines through. It's not just the amazing numbers, the earnings beat, the raised guidance, that ambitious long view. It's the clarity behind it all. This disciplined focus on high-margin services, coupled with that relentless innovation push and the strong shareholder returns. It paints a very, very compelling picture, especially now with airlines focused on making existing fleets last longer.
Which does raise an important question, doesn't it? As the whole aviation world deals with tricky supply chains, economic pressures, environmental targets, what other innovations, maybe ones we haven't even thought of yet, might come out of this intense focus on extending aircraft life and getting the most out of existing assets? And, what could that really mean for the future of flying itself?
A fascinating thought to leave things on. Well, thank you for joining us on this deep dive into GE Aerospace. We really hope you feel a bit more informed, maybe even a little inspired.